Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge, Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Right now, if you look at April 9th, 2026, the global financial markets are basically, well, they're ostensibly celebrating this massive geopolitical ceasefire.
Right, the terror's just gone.
Exactly. The localized terror that's been gripping the markets is just suddenly gone. Bitcoin is, pumping right past that $70,000 threshold, and the sentiment indexes are finally cooling off.
Yeah.
And yet, if you look at the underlying data, the smartest, most powerful institutional money on the planet is currently packing up hundreds of millions of dollars and just running for the exits, which leaves you wondering, why is Wall Street terrified of peace?
Well, because they aren't looking at the peace treaty. They're looking at the mechanical lag of the global economy.
Oh, right.
The data tells us that institutional capital is basically bracing for this mathematical collision that the retail markets simply haven't priced in yet. So what we're seeing is this massive real-time divergence between what the headlines are saying and, well, what the capital is actually doing.
Right. Which brings us to today's deep dive. So welcome in. If you want to understand the actual mechanics behind these headlines, you are in the exact right place today.
Absolutely.
Because we have this massive stack of source material today, all dated April 9th, 2026. And our mission here is to connect these seemingly isolated events.
Yeah, it's a lot to get through.
It really is. We're looking at this sudden geopolitical ceasefire, a highly anticipated drop of macroeconomic inflation data happening literally tomorrow, and then the bizarre duality of cryptocurrency.
Which is fascinating.
Yeah, being adopted simultaneously by pristine Wall Street banks and, sanctioned nation states, plus this fundamental architectural leap in how artificial intelligence actually reasons through complex problems.
Right, and the through line here is it's infrastructure. And every single one of these stories, whether it's global finance or, international shipping, or even cognitive technology, we are watching the most powerful entities on Earth build the pipelines that will basically dictate the next decade.
Yep.
And they're making decisions today based on vulnerabilities that most people, frankly, don't even know exist.
Okay, let's unpack this. We have to start with the geopolitical reality on the ground right now.
Yeah, let's do it.
So there is breaking news of a 2-week ceasefire in what the defense sector is calling Operation Epic Fury.
Right.
And for the listener who, maybe hasn't been tracking the minutiae of this is the ongoing, highly volatile conflict involving the U.S., Iran, and Israel. Now, alongside this 2-week pause in kinetic action, there is this highly guarded 10-point plan being negotiated.
And we need to be incredibly precise about what is actually known regarding that 10-point plan, because there's a lot of noise.
So much noise.
According to the aggregated intelligence in our sources, the specific details of that framework are locked down. Completely locked down.
Right.
They are known exclusively by the Trump administration and high-ranking Iranian officials. There are no authorized leaks. There is no public draft floating around.
Which naturally has created just an absolute vacuum of truth online. I want to make something very clear for anyone trying to navigate this today. The information ecosystem surrounding this ceasefire is completely toxic.
Well, 100%.
We are seeing both left-wing and right-wing influencers, political commentators, open-source intelligence accounts. They are just flooding the zone with highly speculative, completely misleading information.
Yeah, claiming they have the inside scoop.
Exactly. They're claiming they have inside knowledge of the concessions in this 10-point plan. And our mandate today, based on our sources, is to impartially look only at the factual, officially verified updates on these geopolitical negotiations. We are not endorsing any political viewpoint here. We are just, tracking the data.
Right, and that distinction is vital because those speculative narratives are exactly what drive retail market behavior.
Oh, for sure.
When you have an information vacuum, human psychology just fills it with either extreme optimism or extreme pessimism. And in this case, the mere word ceasefire has triggered this massive wave of retail optimism, particularly in the digital asset space.
Yeah, well, let's talk about that optimism, because the numbers are pretty stark. For the first time in 6 straight months, the crypto market sentiment index has shifted out of the fear zone.
Finally.
Yeah, it has finally hit neutral, sitting exactly at an index score of 40.
And to put that in context, 6 months in the fear zone is an incredibly oppressive psychological environment for any market.
Just exhausting.
Right. A sentiment score of 40 means the algorithmic tracking of social media volume, trading momentum, and volatility has essentially concluded that the panic selling has just exhausted itself. The retail participant looks at the geopolitical pause and assumes, okay, the bottom is in.
And the spot price of Bitcoin reflects that exact assumption. The price has pumped to over $70,000. Specifically, our sources have it hovering around $71,001. Now, it is down slightly by about 1.69% in the last 24-hour rolling window. But if you zoom out to the 7-day chart, it is up 4.36%. So to the average observer, the narrative is perfectly clean.
Yeah, it looks great on the surface.
The tension pauses, the fear leaves the market, and the pristine asset reclaims a massive psychological threshold of 70,000.
It is a perfectly logical narrative right up until you look at the institutional order flow.
And this is where we hit the paradox. It's like everyone suddenly agrees the weather is perfect, the storm has passed, but the captains of the biggest mega yachts are all rushing their boats back into the harbor.
That's exactly it.
Despite the price pump, despite the fear leaving the retail market, there are massive coordinated outflows from crypto exchange-traded funds, or ETFs. Our data shows $239.1 million fleeing these funds.
Yeah.
Explain this to me. If the threat is gone and the price is going up, why are the whales, the family offices, the institutional traders, why are they running for the exits?
Well, you have to look at how an ETF physically operates.
Right.
And who is actually using it. An ETF outflow does not represent a retail trader taking $1,000 off the table.
Right.
These funds are structured for high net worth capital. So when $239 million leaves an ETF, it means institutional risk managers are actively redeeming their shares.
No.
Yeah, they're looking at their portfolios and deliberately choosing to reduce their exposure to risk assets.
But why reduce risk when the geopolitical risk was just ostensibly solved by a ceasefire?
Because institutional capital doesn't trade the present. It trades the anticipation of the future. The retail trader looks at the news and says, okay, the ceasefire happened, I will buy.
Yeah.
But the institutional whale looks at the news and says, the retail trader is buying the ceasefire, which pushes the price over 70,000. So I am going to use that retail liquidity as an exit door to lock in my profits.
I see.
They're taking their chips off the table at a premium.
So it's a calculated distribution. They are selling into the retail excitement. But it's more than just locking in a profit, isn't it?
Yeah.
There's a defensive posture here, right?
Absolutely. The profit taking is just the mechanics of it.
Mm-hmm.
The motivation itself is fear. But it isn't fear of Operation Epic Fury. It is fear of a macroeconomic boogeyman that is scheduled to hit the tape tomorrow morning.
Okay, well, let's get into the mechanics of this boogeyman, because this is where the global economy actually runs. Tomorrow, the Bureau of Labor Statistics, and again, the only place you should be looking for this data is the official BLS.gov release. They are dropping the CPI data,
Right.
the Consumer Price Index. This is the official metric for inflation.
And inflation dictates the cost of capital. Geopolitics might dictate the daily mood of the market, but the cost of capital dictates whether businesses can even afford to exist.
So let's look at the ingredients that are baked into tomorrow's inflation report, because there are several massive, basically conflicting forces at play here. First, we have the sheer fiscal cost of the conflict. Operation Epic Fury cost the United States roughly $30 to $40 billion.
That's just massive.
Yeah. Furthermore, leading into the month of April, that conflict severely threatened Middle Eastern supply routes, which drove global oil prices up significantly.
And an increase in crude oil acts as a universal tax on the entire global economy. It raises the cost of manufacturing, the cost of shipping, the cost of agriculture. It permeates every single item in that CTI basket.
Right. But then we have a counterforce.
Hmm.
In a completely separate geopolitical maneuver under what is being called Operation Emirat, or Operation Nemirat, the U.S. government captured Venezuelan ships holding millions of barrels of crude oil.
Yeah, that was huge.
And the operational expectation here is that the U.S. will release this seized oil directly into the domestic market.
Which is a massive, sudden injection of supply designed specifically to crush the price of crude and lower gas prices for the consumer.
And if that wasn't enough conflicting data, we also have recent U.S. labor market reports showing absolute structural strength. The U.S. economy added over 178,000 jobs, which drastically exceeded baseline expectations.
Right.
But wait, so I have to push back here. Let's look at this logically. The ceasefire just happened, which theoretically stops the bleeding of that $30 to $40 billion military expenditure.
Yeah.
We just seized millions of barrels of Venezuelan oil to flood the domestic market and lower gas prices. And the American consumer has a job, as evidenced by the 178,000 new payrolls.
Right, right.
So if the military spending is pausing, oil supply is going up, and employment is strong, shouldn't that mean inflation is going to drop and the economy is in great shape? Why on earth is Wall Street pulling $240 million out of risk assets in a complete panic?
Because of the lag effect. You are applying real-time present-day events to a backward-looking metric.
Ooh.
The BLS report, dropping tomorrow morning, is not a live stream of the economy today. It is a snapshot of the month of March.
Oh, wow. That changes the entire timeline.
It changes the entire mathematical reality. The data we receive tomorrow will absolutely not reflect the recent 10-day ceasefire. It will not reflect the massive influx of seized Venezuelan oil.
Really?
Not at all, because of physical logistics. When a barrel of oil is seized or extracted, it takes 2 to 3 weeks for that crude supply ship to actually be transported, refined into gasoline, distributed to local gas stations, and finally priced into the pump where the consumer actually pays for it.
So when we look at tomorrow's CPI data, we aren't looking at the economy right now. We are looking at a ghost.
Exactly.
We are looking at the economic reality of a month ago, right when the conflict was peaking, right when oil prices were spiking, and right when the U.S. was burning through that 30 to 40 billion.
Precisely. Tomorrow's inflation data is going to capture all of the heat and all of the expense of March without capturing any of the cooling relief of the April ceasefire or the newly seized oil supply. Therefore, the inflation print tomorrow is highly likely to look terrible. It is going to look incredibly hot.
Okay, but if you and I know that, and the institutional risk managers know that, then surely the Federal Reserve knows that.
You would think so.
Yeah, so why is a hot, outdated number so terrifying if everyone knows it's lagging data?
Because the Federal Reserve is trapped by its own mandate. The Federal Open Market Committee, the FOMC, led by Jerome Powell, is scheduled to meet on April 29th. And in that meeting, they have to make the single most important decision in global finance.
Right.
Do they cut interest rates? Do they hold them steady? Or do they hike them up to fight inflation?
The cost of borrowing money.
Exactly. If they raise rates, capital becomes more expensive. Corporate loans cost more. Mortgages cost more. When capital is expensive, institutions pull money out of volatile risk assets like Bitcoin and tech stocks, and they put it into safe, high-yielding government bonds.
Makes sense.
Now, the Fed claims to be entirely data-dependent. If tomorrow's official March CPI data shows inflation spiking violently, the Fed might be politically and structurally forced into making a hawkish decision on April 29th.
Wait, so you're telling me the most powerful financial institution in the world might aggressively raise interest rates, effectively choking the economy based on a ghost?
Yes.
They might make a late April policy decision using peak war data from March, completely ignoring the fact that real-time late April conditions have dramatically improved.
That is the exact window of vulnerability that institutional capital is terrified of. It is the definition of a policy error. The Fed could look at the hot March data and say, well, inflation is out of control, we must keep rates high. And if the Fed stays hawkish, the cost of capital remains oppressive. That is exactly why the whales are fleeing the harbor. They aren't trading the geopolitical ceasefire. They are front-running a potential macroeconomic policy mistake by the Federal Reserve.
That perfectly explains the paradox. The retail trader buys the ceasefire today, but the institutional trader sells the fear of the Fed tomorrow.
Yep, that's it exactly.
But here's where it gets really interesting. Because while the risk managers are sweating over tomorrow's inflation snapshot and moving in and out of ETFs, the actual titans of traditional finance, the foundational plumbing of Wall Street, they seem to be ignoring the short-term noise entirely.
They are.
They are quietly building permanent infrastructure. Let's look at Morgan Stanley. Our sources confirm that Morgan Stanley has just become the first major U.S. bank to officially launch a fully backed Bitcoin ETF. It's called the Morgan Stanley Bitcoin Trust.
Which is a huge deal.
Yeah, the ticker is MSBT. It is listed on the NYSE ARCA, and it just had a massive debut of $33 million. And to be fundamentally clear about how this works, this fund holds actual spot Bitcoin.
This is a monumental shift in the financial architecture. You really have to understand the psychological and logistical barrier that has kept traditional wealth out of cryptocurrency for the last 15 years.
Right, the learning curve.
Exactly. A 65-year-old high net worth individual or a corporate treasury manager is not going to download a decentralized wallet. They're not going to write a 12-word seed phrase on a piece of metal and hide it in a safe. The operational risk of self-custody is entirely unpalatable to traditional wealth.
Right. If you lose that piece of paper, your millions are just gone forever. There is no password reset.
Exactly. But what Morgan Stanley has done with MSBT is abstract all of that friction away. They are allowing traditional brokerage clients to gain direct exposure to the underlying price of Bitcoin within the exact same highly regulated, insured, legally compliant dashboard where they hold their Apple stock and their treasury bonds.
Oh, wow.
Yeah, it's the ultimate stamp of institutional legitimacy. Wall Street has taken this wild, decentralized rebel currency and essentially dressed it up in a pristine, custom-tailored suit.
It's completely sanitized. But then you flip the geopolitical coin. Because at the exact same time Morgan Stanley is doing that in New York, we have concrete intelligence regarding how this exact same technology is being deployed by state actors.
This is where it gets really complicated.
Yeah. There have been whispers for a while that Iran was accepting crypto for transit payments through the Strait of Hormuz. But TRM Labs, who are, one of the most respected blockchain intelligence firms in the world, they provided a massive insight in our sources today.
Right.
They found that Iran actually formally approved a Strait of Hormuz management plan on March 30th and 31st of 2026. This plan officially codifies a system that TRM says has already been actively using crypto for maritime transit payments since mid-March.
This is the duality of the blockchain laid bare. It is the exact same underlying technology being utilized for two diametrically opposed purposes.
It is genuinely staggering to think about. On one hand, you have Morgan Stanley leaning on the transparency and the auditability of the blockchain to create a highly regulated, SEC-approved investment vehicle for American wealth.
Yeah.
On the other hand, you have a sanctioned nation-state utilizing the borderless, permissionless nature of that exact same network to operate a massive toll booth on one of the most critical geopolitical choke points on the planet, entirely outside of the Western financial system.
Which brings us to the regulatory nightmare. You have to look at this through the lens of the U.S. Treasury Department. For decades, the primary nonviolent weapon of the United States and its allies has been economic sanctions.
Right.
And the mechanism for enforcing those sanctions is SWIFT.
The Society for Worldwide Interbank Financial Telecommunication.
Exactly.
Yeah.
SWIFT is essentially the global messaging system that banks use to securely authorize international wire transfers. If the U.S. government sanctions a nation-state, they use their leverage to cut that nation's banks out of the SWIFT network.
Yeah, effectively excommunicating them.
Once you are cut out of SWIFT, you are functionally isolated from the global economy. You cannot send or receive international payments through the traditional banking system.
Unless you bypass the banks entirely.
Unless you demand payment in a sovereign agnostic digital asset. The blockchain does not care about U.S. sanctions. It is a mathematically neutral network.
Wow.
If an international shipping conglomerate has a fleet of oil tankers that absolutely must pass through the Strait of Hormuz, and the regional authority mandates that transit tariffs be paid in cryptocurrency, well, the shipping company has no choice but to acquire and transfer those digital assets.
But mechanically, how is that actually happening? Let's walk through it. Because we just talked about Bitcoin pumping to $70,000, but we also know it can drop 10% in a single afternoon.
True.
If you are a shipping conglomerate trying to settle a $50 million transit tariff, You physically cannot use a currency that volatile. The value of the payment could drop by millions of dollars while the ship is literally in transit.
You've identified the exact friction point of using Bitcoin as a medium of exchange for global trade. Bitcoin is a tremendous store of value and an incredible speculative asset, but it is a terrible unit of account for maritime logistics.
Right.
That is why, to understand how this Hormuz management plan likely operates, we have to look at stablecoins.
Cryptocurrencies that are pegged one-to-one with a fiat currency, usually the US dollar.
Correct. A stablecoin provides the borderless, instantaneous, non-swift settlement rails of the blockchain, but it completely removes the price volatility. And the scale of the stablecoin market is massive.
Oh, yeah.
Our sources highlight that Tether, or USDT, is currently moving a daily volume of over $84 billion. Circle's USDC is moving over 11 billion. FTUSD is moving nearly 40 million. These are gargantuan, highly liquid pools of synthetic digital dollars.
So an international shipping company can acquire $50 million in Tether, send it across a blockchain to an Iranian port authority wallet in roughly 3 seconds, pay exactly $50 million in value, and completely bypass the SWIFT messaging system and Western sanctions.
That is the exact mechanism. And from a regulatory perspective, this is terrifying. It opens up sovereign-scale avenues for money laundering and terror financing that the U.S. Treasury physically cannot interdict.
Unbelievable.
You can see the transaction on the public ledger, but you cannot stop the math from executing.
So U.S. regulators are currently watching Morgan Stanley enthusiastically onboard domestic American wealth into this technology, while simultaneously watching global maritime shipping transition to a parallel, sanction-proof financial rail using the exact same technology.
Yes.
But this dual adoption by Wall Street suits and sanctioned states begs a much larger, almost philosophical question about the cryptocurrency industry itself. I mean, what happened to the original vision? What happened to decentralization?
That's a great question.
Let's look at the cold, hard numbers from our sources today, because the scale is difficult to comprehend. The global crypto market cap is sitting at $2.50 trillion.
Huge.
The 24-hour trading volume is $102.40 billion. Ethereum is priced at $2,190, maintaining a 10.59% market dominance. Ripple, XRP, has surged to $1.74, actually overtaking Binance Coin with a market cap of $82.40 billion.
Which, as an aside, is a massive structural shift in the hierarchy of alternative Layer 1 networks.
And it isn't just the utility networks, right? The speculative casino is still wide open. Meme coins represent $34 billion of this market. Dogecoin is sitting at a $14.19 billion market cap. Meme coin is at $4.72 billion. Shiba Inu at $3.69 billion, Pepe at $1.39 billion, and the Pump.Fun ecosystem is over $1 billion.
The speculation is just relentless.
It is. So we have a $2.5 trillion asset class moving hundreds of billions in daily volume. But when you look at decentralized exchanges, the numbers are absolutely dismal.
Very true.
Our sources show the total 24-hour DX volume is only $6.63 billion. Their overall market dominance is under 20%, currently sitting at just 18.69%. And the total value locked, the TVL, across all of decentralized finance is only $95.36 billion out of that $2.5 trillion total.
And even within that incredibly small slice of the pie, the liquidity is heavily centralized among a few major players. Uniswap leads the pack with $1.56 billion in volume, followed by PancakeSwap at $894 million, Airdrome at $621 million, Fluid at $325 million, and Orca at $278 million.
I have to challenge the entire premise of the industry here. Bitcoin is over 15 years old. The entire marketing pitch, the literal Genesis block manifesto written by Satoshi Nakamoto was about decentralization.
Right, peer-to-peer.
It was about creating a distributed, trustless way of transacting without corporate beekeepers. Yet, looking at the actual functional data today, less than 20% of trading happens on decentralized platforms. More than 80% happens on centralized corporate exchanges or via Wall Street ETFs. Isn't this a massive, undeniable failure of the original vision?
This raises an important question, and it forces us to separate the ideology of the technology from the reality of human behavior.
Okay.
You are mathematically correct. Decentralization as a mechanism for mass market trading is losing. But we have to rigorously analyze why it is losing. It is failing because the mechanics of human convenience and institutional compliance are vastly stronger than cypherpunk ideology.
Break that down for me. What is the actual mechanical failure of a DX for the average user?
It starts with the UX/UI barrier, the user experience and user interface. Interacting with a decentralized exchange requires a level of technical competence and absolute personal liability that the average human being actively despises.
Yeah, it's not exactly plug and play.
Not at all. To use Uniswap, you have to manage a self-custody wallet. That means you hold the private cryptographic keys. You have to write down a 12-word seed phrase, store it offline, and ensure no one ever finds it.
And if you type the wrong smart contract address when sending a transaction, your money doesn't bounce back. It goes into the void.
Exactly. If you make a mistake on Coinbase or with your Morgan Stanley broker, you pick up the phone, verify your identity, and customer service reverses the error.
Right.
If you make a mistake on a DX, the blockchain executes the transaction flawlessly, and your money is irretrievably gone. The average consumer does not want absolute financial sovereignty. They want a customer service safety net.
Yeah, that makes a lot of sense.
Furthermore, because DXs have lower total value logged, meaning there is less latent capital sitting in the liquidity pools waiting to facilitate trades, they suffer from severe slippage.
Slippage meaning you don't get the price you asked for.
Right. Think of it like buying a fleet of cars. Using a DX for a massive trade is like trying to buy 500 cars by walking into 100 different local dealerships and haggling with each manager individually.
That sounds like a nightmare.
It is. The more cars you buy, the more the local supply dries up, and the higher the price goes for the last few cars. The price slips away from you.
Which explains the consumer failure. But what about the institutional failure? Why aren't the billionaires using DX?
That brings us to the regulatory paradox. And our sources give us a perfect real-time example of this happening in Dubai.
Okay.
The Virtual Assets Regulatory Authority in Dubai, VRA, just issued a full virtual asset service provider license to a company called Realm, which operates under Xbase.
Right.
This license explicitly allows Realm to operate as a fully regulated broker-dealer for institutional, enterprise-grade, over-the-counter, or OTC crypto trading.
Over-the-counter meaning direct trades that don't hit the public order books.
Correct. Using our car analogy, an OTC desk in Dubai is like calling the global manufacturer directly and negotiating a flat, guaranteed wholesale rate for all 500 cars behind closed doors. There is no slippage. But more importantly, there is legal compliance. Traditional institutions, sovereign wealth funds, and family offices have strict fiduciary duties. They are legally required to perform anti-money laundering checks and know your customer protocols.
They have to do AML and KYC.
Yes. They have to prove exactly where their capital is going and who is receiving it. Because a decentralized exchange is literally just a faceless smart contract living on a blockchain, it cannot perform a background check. It cannot provide a legal entity to sue if something goes wrong. Therefore, institutions physically and legally cannot connect their treasuries to a DX.
So, in order for the cryptocurrency industry to grow from a niche rebellion into a multi-trillion-dollar global asset class, it had to abandon its core tenet.
It did.
The Wild West had to build sheriff's offices. It had to consolidate, mature, and centralize in order to legally absorb traditional wealth.
It is the inevitable life cycle of any disruptive technology. The open, decentralized frontier is always eventually enclosed and regulated by the established system because capital demands safety.
Which is the perfect transition, because we are watching this exact same philosophical war, this brutal tension between open, decentralized freedom and closed, centralized security, playing out in real time right now in the most important frontier of our generation, which is artificial intelligence.
The structural parallels between the crypto ecosystem and the AI research labs are truly striking. We're dealing with the exact same questions of governance, access, and systemic risk.
Let's get into the AI data from our sources today. Meta, the company formerly known as Facebook, has just launched a new flagship model called MuseSpark.
Right.
This is a multimodal AI model. And to be clear on terms, multimodal means it isn't just reading and generating text. It natively processes text, analyzes images, and executes highly complex reasoning tasks simultaneously.
But the true architectural leap they are marketing here is a feature called contemplating mode. This is designed to directly compete with the absolute frontier models like Gemini DeepThink and OpenAI's GPT Pro.
Okay, we need to explain how this actually works under the hood. How is contemplating mode different from the ChatGPT we've been using for the last few years?
Well, traditional large language models, standard LLMs, operate fundamentally on pattern recognition and next token prediction.
Right.
You ask it a question, and it calculates the highest probability of what the next word in the answer should be based on the vast amount of human text it ingested during training. It is incredibly fast, but it is linear. It gives you its best guess in a single shot. Contemplating mode, however, represents a paradigm shift from a single model to a multi-agent orchestration.
Let me try to put an analogy to this. A standard LLM is like asking one brilliant, incredibly well-lit professor a question. They give you the best answer they can come up with off the top of their head in 5 seconds.
Yes.
But contemplating mode is like Meta is taking an entire board of directors, experts in logic, mathematics, coding, and creative writing, locking them in a conference room and not letting them out until they debate, verify, and arrive at the absolute best solution together.
That is functionally exactly how it operates. Instead of predicting the next word, the system spawns multiple AI agents. Agent A proposes a theoretical solution to your complex math problem. Agent B acts as a critic, actively searching for logical fallacies in Agent A's work.
Oh, wow.
Agent C runs a simulated test of the code to see if it compiles. And Agent D synthesizes the verified findings into a final response. This multi-step, self-correcting, recursive loop allows the system to tackle problems that require deep, deductive reasoning rather than mere information recall.
And the benchmark results validate that architecture. Meta ran MuseSpark through a benchmark called Humanity's Last Exam, which, as an aside, is the most aggressively dramatic sci-fi name for a software test I have ever heard.
It is intensely dramatic, but appropriately so. Humanity's Last Exam is currently the gold standard for testing frontier reasoning.
Right.
It is comprised of incredibly dense, complex questions covering advanced mathematics, theoretical physics, and cutting-edge scientific research questions that standard LLMs consistently fail because you cannot solve them through simple pattern recognition.
And our sources show that MuseSpark scored approximately 58% on this exam. Now, to a listener, a 58% might sound like a failing grade in high school algebra. But in the context of advanced machine reasoning, hitting nearly 60% on Humanity's Last Exam is a staggering historical achievement.
It undeniably proves the efficacy of the multi-agent approach. But here is where we slam right back into the crypto debate.
Right.
Who gets to control this power? Is this technology decentralized and open to the world?
No. It is entirely locked down. The source code, the model weights, and the API from MuseSpark are strictly private and proprietary. It is a completely closed corporate system.
Yes, it is.
And Meta's explicit justification for this centralization is safety. Specifically, they have implemented what they call a bioweapons refusal guardrail, which forces us to examine how the sheer capability of a technology dictates its governance.
Right. Meta prioritized safety protocols designed to physically prevent MuseSpark from assisting a user in developing biological or chemical weapons or providing tactical roadmaps for severe cybersecurity attacks.
Its stakes are incredibly high.
Yeah. The logic is that because this model has advanced multi-agent reasoning, it isn't just recalling facts from Wikipedia anymore. The fear is that a bad actor could prompt the model to legitimately deduce the synthesis of a novel pathogen or logically map out zero-day vulnerabilities in a nation's power grid.
Exactly.
Because those existential risks exist, Meta has sealed the system. You can chat with it, but you cannot look at the code, and you cannot download it to run on your own servers.
Now contrast that corporate lockdown with the developer sentiment highlighted in our sources regarding open source models, specifically a model called OpenClaude.
The sources indicate that independent developers and startup founders vastly prefer open source models like OpenClaude, primarily because it prevents vendor lock-in.
Yeah.
If you spend millions of dollars building an enterprise application that relies entirely on MuseSpark's API, and Meta suddenly decides to quadruple their pricing or alter the model's political alignment or shut off your access, your entire company dies overnight.
It's a huge risk.
With an open source model, you download the architecture, you run it on your own hardware, and you possess total sovereign control over your infrastructure.
So we arrive at the core debate of our time. From your perspective, looking at the data, is closed source justified simply because of the bioweapons risk? Or is that just a corporate excuse for monopoly?
It is the ultimate societal trade-off. It is the exact same dynamic as the Dubai VARA license we just talked about. You are being asked to trade the freedom and sovereign control of an open system for the safety and compliance of a centralized authority.
If we connect this to the bigger picture, the tension is agonizing. From the perspective of academic researchers and independent developers, a closed-source frontier model is a massive societal red flag.
Oh, absolutely.
It completely hinders independent security audits. We are essentially being asked to blindly trust Meta's internal PR team that their bioweapons guardrails actually work, because independent security researchers are physically blocked from looking under the hood to verify the code.
Right.
Furthermore, it centralizes the cognitive engines of the future into the hands of 3 or 4 massive tech monopolies.
But then you have to look at it from a geopolitical security standpoint.
Exactly. From the perspective of global security, keeping these models proprietary is viewed as a non-negotiable quarantine. The reality of AI-assisted bioweapons or automated cyber warfare is no longer a theoretical exercise. It is an imminent threat.
It really is.
If you take a model that can score 58% on humanity's last exam and you open source the weights, it is instantly downloaded by rogue nation-states and terrorist organizations. They strip out the safety guardrails, and they utilize that multi-agent reasoning power to engineer mass destruction. In that scenario, centralized control is the only thing preventing global catastrophe.
But we can't just talk about this technology as some abstract doomsday device hovering over the geopolitical landscape. We need to ground this in how this level of intelligence is actually filtering down to the consumer market right now.
Right, the everyday use cases.
Because it is fundamentally changing how human beings interact with machines. Let's look at the incredibly practical application detailed in our sources coming out of Saudi Arabia today. There is a leading travel company there called Al-Mosafir, and they have just become the very first app in the kingdom to integrate directly with ChatGPT's advanced models.
This is the perfect micro-example of applied AI transforming a massive legacy industry.
Al-Mosafir allows users to search and book over 1.5 million hotels globally. But what is revolutionary here isn't the inventory, it's the interface. They are entirely eliminating the traditional architecture of the internet.
Yeah.
They are getting rid of the drop-down menus, the date picker calendars, the search filters, and the endless clicking. Instead, users can plan and book their entire journey through natural conversational AI, fully supporting both Arabic and English.
This is what AI looks like when it hits the ground. Think about how much of your day is spent navigating menus, filling out forms, or arguing with bad search filters to get a machine to do what you want.
Oh, constantly.
We have spent the last 30 years forcing human behavior to adapt to machine interfaces.
Yeah.
We learned to click through rigid hierarchies. What the Al-Mosafir integration represents is the exact opposite. The machine is finally adapting to human behavior.
Think about the friction of booking a complex vacation. If I want to book a multi-city VIP travel itinerary for a family of 4, traditionally, that is a frustrating 45-minute process.
Easily.
I have multiple tabs open. I am cross-referencing flight times with hotel check-ins. I am looking at Google Maps to figure out how far the hotel is from the museum we want to visit. I am trying to filter for specific amenities like adjoining rooms and a pool.
It's terrible.
With this integration, that entire 45-minute ordeal becomes a single zero-click conversational flow. You just tell the app, I need a 2-week trip for my family, starting in Riyadh and ending in Dubai. Find me 5-star hotels that are within walking distance of the major museums, ensure they have a pool, and keep the total budget under this amount.
And behind the scenes, a localized version of that multi-agent contemplating mode spins up. One agent pings the flight databases, another agent checks hotel availability and maps the walking distances.
It's wild.
A third agent calculates the currency conversions and budget constraints, and within seconds, it returns a fully bookable, customized itinerary. It transforms multi-click friction into zero-click commerce.
It is a mass extinction event for bad user interfaces. When conversational commerce becomes the standard expectation for the consumer, any business that still forces users to navigate traditional menus and forms will simply die out. You will no longer navigate the internet, you will just converse with it.
And it brings everything we have discussed today completely full circle. We are looking at a world that is vastly accelerating in its underlying complexity, but radically streamlining in its execution.
Let's take a breath and synthesize the massive amount of ground we have covered today. Because the dots we started with in the outline, the ceasefire, the inflation data, the crypto duality, the AI agents, they are all deeply structurally connected.
They absolutely are.
We started in the physical world, a 2-week geopolitical ceasefire and Operation Epic Fury, and we saw how the institutional whales are fleeing the seemingly safe crypto markets, not because they doubt the technology, but because they are terrified of the macroeconomic lag hiding in tomorrow's March inflation data.
Right.
They are fleeing the harbor because they are bracing for a backward-looking Federal Reserve to make a policy mistake on the cost of capital.
We then explored how that exact same crypto asset class is navigating a profound identity crisis. We have Morgan Stanley wrapping Bitcoin in a highly regulated SEC-approved ETF suit for traditional wealth, while sanctioned states like Iran are utilizing the borderless, permissionless nature of stablecoins to bypass Western SWIFT sanctions in the Strait of Hormuz.
A duality that perfectly explains the ultimate death of the original cypherpunk decentralization dream. We looked at the dismal volume on decentralized exchanges, realizing that institutional capital fundamentally requires the regulatory safety, the AML compliance, and the central authority provided by entities like Dubai's VOR.
Yes.
And finally, we watched that exact same war between open freedom and closed security play out in artificial intelligence. Meta's Muse Spark utilizes multiple AI agents orchestrating in contemplating mode to solve highly complex frontier problems, but Meta is forced to lock that technology away behind corporate walls to prevent the synthesis of bioweapons.
Which is necessary but controversial.
Meanwhile, companies like Al-Mosafir are deploying that exact same reasoning power to completely eliminate the friction of consumer commerce, ushering in the era of the zero-click internet.
The overarching narrative of April 9th, 2026 is that the institutions, the banks, the nation-states, the tech monopolies, are aggressively laying down the centralized pipes that will govern the next era of global digital value and information transfer.
Which leaves me with a final lingering thought for you to mull over as you watch these headlines develop.
Yep.
We talked at length about how Meta's new AI architecture orchestrates a board of directors of digital agents to autonomously debate and solve highly complex logic problems.
Right.
And we talked about how traditional Wall Street banks and sovereign nation states are currently building the regulated, automated, blockchain-based pipes for instantaneous global value transfer. So if we extrapolate this trajectory out just a few more years, well, if swarms of AI agents are about to become the primary engines for complex deductive reasoning, and the global financial rails are fully digitized, tokenized, and programmable, will the future of global finance and geopolitics eventually become completely autonomous?
It's a huge question.
Will we reach a point where human leaders, central bank chairs, and institutional risk managers are no longer actually making the day-to-day strategic decisions? Will human beings be reduced to simply providing the initial prompts, setting the high-level macro goals, and then stepping back while millions of AI agents autonomously negotiate trade tariffs, execute complex derivative trades, and manage global supply chains at light speed across the blockchain?
It sounds like science fiction, but the infrastructure is being laid right now.
Are we building a global economy that will eventually be too fast and too complex for human beings to actually steer? Keep questioning the narrative, keep looking past the headlines to the underlying mechanics, and we will catch you next time as we continue to track these shifts in our next deep dive.